The financial markets are closely monitoring the upcoming Federal Reserve meeting, with expectations that interest rates will remain unchanged. However, investors will be keenly observing the Fed's tone for any dovish signals that could indicate future rate cuts. The EUR-USD currency pair has been trending upwards, and a dovish stance from the Fed could push the euro past the $1.16 resistance level. Current market forecasts suggest the Fed might delay its next interest rate cut until September, primarily due to uncertainties from ongoing trade tensions, particularly the broad tariff war initiated by the U.S. Recent GDP data showing a quarterly decline, the first since November 2022, could prompt the Fed to consider easing rates sooner if this negative trend continues. Inflation in the U.S. remains within the 2 to 2.5% range, with figures falling below expectations for 4 consecutive months, which does not preclude potential rate cuts. Progress on trade agreements, especially with China or the EU, could exert downward pressure on the U.S. dollar, influencing the Fed's decisions. Meanwhile, the European Central Bank, ECB, is nearing the end of its monetary easing cycle, as indicated by ECB President Christine Lagarde's recent comments. The Eurozone's inflation concerns and potential trade disputes with the U.S. could impact the euro's strength. If the EUR-USD pair breaks the 1.16 resistance, it could target levels above 1.23, contingent on developments that could weaken the U.S. dollar, such as successful trade negotiations or a shift in the Fed's policy stance.
Chancellor Rachel Reeves faces mounting pressure to reconsider recent tax reforms, particularly changes to the inheritance tax (IHT) regime, as concerns grow over their impact on the UK's global competitiveness. The reforms, which include the scrapping of the non-domiciled (non-dom) tax status and a new rule subjecting global assets to a 40% death duty, have sparked alarm among wealthy individuals and international investors. Notable figures such as steel magnate Lakshmi Mittal and Egypt's richest man Nassif Sawiris are reportedly leaving the UK in response. The City of London and international investors are lobbying against these changes, fearing they could diminish London's appeal as a financial hub. The Treasury is reportedly reviewing the IHT changes, particularly as financial advisors warn of an increased tax burden on estates due to frozen IHT thresholds, rising pension values, and soaring property prices. A report by wealth manager Quilter predicts a significant rise in the number of estates exceeding the £2 million threshold, thus losing part or all of their IHT allowances. The government's plan to include pensions in the IHT scope from April 2027 could further exacerbate the situation, with expectations to generate £1.46 billion annually by the decade's end. The Treasury maintains that it will continue to work with stakeholders to ensure the tax regime remains competitive, but any adjustments could provoke political backlash, especially if perceived as favoring the wealthy over vulnerable groups.
Tensions between Israel and Iran have raised concerns on Wall Street regarding the potential impact on the Strait of Hormuz, a vital corridor for global oil transportation. The strait, located between Iran and Oman, is crucial for the flow of about 20 million barrels of oil daily, representing around 25% of the world's oil supply according to the International Energy Agency. Despite the escalating conflict, global markets have remained relatively stable, but experts warn that any disruption in the strait could trigger a significant spike in oil prices, potentially reaching $100 per barrel. The recent rise in oil futures, with U.S. oil closing at $74.84 and Brent crude at $76.45 per barrel, reflects traders' cautious monitoring of the situation. The possibility of Iran attempting to block the strait or targeting oil infrastructure has heightened market anxiety. The Joint Maritime Information Center has noted a minor decrease in vessel transits through the strait, although it remains open for commercial traffic. Analysts suggest that while closing the strait might be challenging for Iran, the conflict could still disrupt oil production and maritime traffic through other means. The uncertainty surrounding the conflict's development keeps markets on edge, as any sudden escalation could lead to significant disruptions in global oil supply, impacting prices and potentially leading to broader economic consequences.
Republican lawmakers are advancing a legislative proposal aimed at eliminating payment pauses for federal student loan borrowers facing unemployment or economic hardship. This move, part of the broader One Big Beautiful Bill Act, seeks to remove the unemployment and economic hardship deferments that currently allow borrowers to temporarily suspend payments without accruing interest. The House has already advanced its version of the bill, while the Senate Committee on Health, Education, Labor, and Pensions has proposed recommendations, setting the stage for further debates. Critics, including Abby Shafroth from the National Consumer Law Center, warn that this change could lead to an increase in defaults among borrowers who lose their jobs or face unexpected financial challenges. The proposed legislation aligns with Republican views on reducing taxpayer burdens, as articulated by Senator Bill Cassidy, who argues that the current system unfairly shifts the responsibility of student loans onto those who did not attend college. The GOP contends that eliminating these deferments could encourage borrowers to choose repayment plans that better align with their financial situations, potentially saving taxpayers an estimated $300 billion. However, experts caution that without these deferments, many borrowers might resort to forbearance, where interest continues to accumulate, potentially leading to larger debt burdens upon resumption of payments. This legislative shift comes amidst broader discussions on student loan policies and their implications for borrowers and the economy.
The recent viral thread by finance commentator Pilot Investor has spotlighted the escalating real estate prices in urban India, emphasizing the inability of high-earning professionals to afford basic housing. Despite earning 20 lakh rupees annually, which places them among the top 5% of Indian earners, individuals in cities like Gurgaon, Mumbai, and Bangalore find themselves priced out of the housing market. The commentary suggests that the market is skewed by cash-heavy investors who use real estate as a means to park undeclared wealth, thus inflating property prices beyond the reach of salaried professionals. The discussion highlights a dual market structure, one where documented incomes meet transparent pricing, and another where undeclared wealth influences transactions. This has led to developers offering premium amenities to justify inflated costs, often involving large cash components. Pilot Investor argues for a systemic digitization of real estate transactions, akin to reforms in banking, to enhance transparency and accountability. They suggest that such measures could potentially correct the artificial inflation of property prices, thereby realigning the market to serve its primary purpose of providing affordable housing. This call for reform is seen as essential to prevent legitimate earners from being sidelined in a distorted market.
Shiv Puri, in a recent interview, discussed the resilience of global equity markets amidst ongoing chaos, highlighting India's position in this landscape. Despite high valuations, particularly outside large caps, India's financial system benefits from free-flowing credit and a stabilizing earnings outlook. Liquidity has improved over the past year due to increased reserve flows and rate cuts, aiding credit expansion. However, valuations remain stretched in mid-cap and small-cap segments, suggesting that large caps may offer more attractive entry points for investors. India's economic resilience is further underscored by its limited exposure to global tariff uncertainties, given that exports form a relatively small part of its GDP and are concentrated in services. The earnings cycle in India shows signs of recovery, driven by improved credit flow, rising rural consumption, and increased government capital expenditure, although urban consumption and private sector capex still lag. Puri emphasizes the potential in large-cap private financials and select healthcare stocks, particularly hospitals, which offer long-term growth potential with strong execution and capital discipline. The premiumization trend in India continues robustly, reflecting a shift in consumer spending patterns towards premium products, particularly in travel, leisure, and services sectors.
Dynamic Advisor Solutions LLC has significantly reduced its position in the iShares Short Treasury Bond ETF, NASDAQ, SHV, by selling 43,391 shares, equating to a 77.3% decrease in its holdings during the first quarter. This reduction leaves the firm with 12,735 shares valued at approximately $1,407,000. The iShares Short Treasury Bond ETF, which tracks the performance of U.S. Treasury obligations with maturities between 1 and 12 months, saw a modest trading price of $110.24, closely aligning with its 50-day and 200-day moving averages, indicating relative stability in its price performance. The transaction comes amid a broader trend where various hedge funds and institutional investors have been adjusting their positions in the ETF. Notably, several new stakes were acquired during the fourth quarter by firms such as Menard Financial Group LLC and Trans 3ND LLC, reflecting a diverse range of investment strategies. The ETF also announced an increased dividend payout of $0.397 per share, up from its previous dividend of 37 cents, signaling a positive yield outlook for investors. This financial maneuvering reflects ongoing strategies to optimize portfolios in response to the current economic climate, marked by fluctuating interest rates and market conditions.
Bank Negara Malaysia (BNM) has committed to managing the stability of the ringgit amid ongoing market uncertainties. The ringgit has reached its strongest level since October, outperforming other emerging Southeast Asian currencies this quarter. Deputy Governor Adnan Zailani Mohammed Zahid emphasized the central bank's readiness to curb excessive volatility and maintain a well-functioning market. This commitment comes as geopolitical tensions continue to fuel market anxiety, highlighting the fragile economic environment. The ringgit's robust performance is attributed to coordinated efforts by the Malaysian government and BNM to stimulate capital inflows and the narrowing interest rate gap between Malaysia and the U.S. Such measures have been instrumental in bolstering the currency, reflecting a strategic approach to managing economic challenges. The central bank's vigilance in ensuring the ringgit's stability is crucial for maintaining investor confidence and supporting Malaysia's economic resilience in the face of global uncertainties.
The World Bank has highlighted the significant economic potential of increasing female workforce participation in the Pacific Islands, where less than half of working-age women are currently employed. According to a recent report, outdated laws and various barriers contribute to this low participation rate, with 57% of women not engaged in formal employment. The World Bank suggests that aligning female employment rates with those of men could increase the region's GDP by 22%, driven by higher household incomes and enhanced private sector growth. The report also projects a slowdown in regional economic growth, forecasting a decline from 5.5% in 2023 to 2.6% in 2025. This deceleration underscores the urgency of addressing gender disparities in the labor market as a means of sustaining economic momentum. By removing barriers to female employment, the Pacific Islands could not only stimulate economic growth, but also improve overall economic resilience. The emphasis on gender equality aligns with broader global trends, recognizing the importance of inclusive economic policies in driving sustainable development.
QuantumScape Co., NYSEQS, a company specializing in the development of solid-state lithium metal batteries, has seen significant institutional activity, with Optas LLC purchasing a new stake valued at approximately $63,000 during the first quarter. This move is part of a broader trend of institutional investments in QuantumScape, as evidenced by recent positions taken by Y-Intercept, Hong Kong Limited, and Raymond James Financial Inc., among others. Despite these investments, QuantumScape's stock has faced challenges, including a series of insider sales and a recent earnings miss, reporting a loss of 21 cents per share against an expected 19 cents loss. The company's stock has experienced volatility, with a 2.9% increase to $4.47, yet remains below its 200-day moving average of $4.62. Analysts have expressed mixed sentiments, with several downgrading their ratings and lowering price targets, citing concerns over the company's financial performance and market conditions. QuantumScape's market capitalization stands at $2.50 billion, and it currently operates with a high beta of 4.27, indicating significant volatility relative to the broader market. As QuantumScape continues its R&D efforts in battery technology, investors remain cautious, as reflected in the consensus hold rating and a target price of $5.19.